This is Nightly Business Report with Tyler Matheson and Sue Herrera. Funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt, to move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.
Crude cracks. The energy market faces its next big test as the price of crude drops sharply and suddenly.
Report card. Engineers give America's roads and bridges a near failing grade and a big bill to fix them.
Flip or flop, why that move-in ready dream house can quickly turn into a nightmare. Those stories and more tonight on Nightly Business Report for Thursday, March 9th.
Good evening, everyone, and welcome. The price of oil is plummeting. Crude lost 7% of its value in just 2 days. The tumble was quick, it was steep, and it seemingly came out of nowhere. Today, prices settled below $50 a barrel for the first time this year. Prior to the decline, prices had held relatively steady in the mid-$50 range as a result of OPEC's decision to cut production. But as Jackie DeAngelis reports, that strategy is being put to the test.
The sell-off was sudden and sharp. Domestic crude had been stable for months, remaining around that mid-50 range, but no more. The straw that broke the camel's back, a wait-and-see approach from OPEC regarding extending its production cut. That cut supporting the market since it was announced. Also, activities here at home.
The market finally reacted to really swelling oil inventories here in the U.S. They're at a record level. They continue to grow. They're going to continue to get higher and higher. Finally, the market couldn't bear up under that any longer.
But it's a bit of a delayed reaction. Supply has been steadily increasing in the United States. Rig counts are up. Companies are raising spending plans, all to take advantage of higher prices. The big question, will American shale producers ramp up output and ultimately undo what OPEC tried to do when it curbed production?
U.S. shale production has risen steadily now over the past several weeks. We are back over 9 million barrels per day. They are in the process of undoing in its entirety the very cuts OPEC and some other non-OPEC countries, particularly Russia, were trying to engage in. This is helping to reflood the market with oil, and it's a real threat to the price stability that we had experienced over the past couple of months.
But don't underestimate OPEC and the Saudis. With Aramco, that's Saudi Arabia's state-run oil company, looking towards an IPO, there's a strong incentive to keep prices on the high side. If OPEC and the Saudis were to extend the current production cut, industry analysts say prices could head back higher. For Nightly Business Report, I'm Jackie DeAngelis.
On Wall Street today, trading was choppy as the move in oil prices starts to ripple through the broader market. Investors were also in wait-and-see mode ahead of the monthly jobs report due out tomorrow. Today, the Dow Jones Industrial Average rose just 2 points to 20,858. That's wait and see, folks. The NASDAQ and the S&P 500 were both up a point and change.
Well, as Ty mentioned, small moves in the market today, but that wasn't the case 8 years ago. We were in the depths of the financial crisis, and if you were like many investors, you were probably holding your head, nervous about the future. If only you knew then what you know now. That was the bottom, the worst of it, and since then, stocks have climbed, making this the second longest bull run in market history. Morgan Brennan takes a look back and a look ahead.
Happy birthday to the bull market, that is. 8 years ago today, the market hit its bottom after free falling in the worst financial crisis to sweep the globe since the Great Depression. So much has changed since then. The end of the recession, a tidal wave of global monetary stimulus, 2 presidential elections, a commodity price collapse, and just recently, a record string of record market highs.
Everybody's down here talking happily about 8 years ago when the market bottomed. And they seem to have forgotten 8.5 years ago when Paulson and Bernanke actually discussing the possibility of invoking or declaring martial law in the United States. That's how close we came to the wheels coming off the locomotive.
The S&P 500 has surged almost 250%. The Dow Jones Industrial Average has more than tripled, and the NASDAQ has outdone both, up more than 350%. What's led the rally? Consumer discretionary stocks like beauty product retailer Ulta Beauty, which has surged more than 6,000%. Also biotech stocks like Incyte and Regeneron, which have gained more than 6,000 and 3,000% respectively. And Apple, up over 1,000%, has been by far the biggest standout in the Dow, which had only joined in 2015. The biggest losers, energy names like Southwestern Energy and Transocean, which have plunged alongside oil prices. Even ExxonMobil, despite a 50% gain, has been the worst performer in the Dow. This bull market is the second oldest in history, behind the 13-year streak that ended in 2000. But on this birthday, investors are beginning to ask, will this bull market continue to charge forward? For a nightly business report, I'm Morgan Brennan.
The insurance company AIG has come a long way since that financial crisis, but today its CEO said he's stepping down. Peter Hancock, appointed less than 3 years ago, will remain as chief executive until a replacement is found. Recently, AIG posted a quarterly loss of $3 billion, worst performance since that financial crisis. Back in 2008, the company was near collapse and required a $180 billion bailout.
America's infrastructure gets a near failing grade. The American Society of Civil Engineers assigned our nation's roads, bridges, levees, and other infrastructures a grade of D+. That's the same grade as 4 years ago, when the last report was released, and it suggests that only minor progress, if any, has been made. And the price tag to fix it is steep. Aditi Roy reports from Sacramento.
The Sacramento River, like so many other bodies of water in America, is lined with levees. Levees in desperate need of repair.
There's an estimated up to 100,000 miles of levees nationwide, and across the whole country they're in a pretty sad state of repair. By the number of levees in the Army Corps of Engineers Rehabilitation Program, just 1.8% of levee miles are rated acceptable, the highest grade.
Levees got a D grade in the newly issued report card on America's infrastructure, released every 4 years by the American Society of Civil Engineers. That's still a step up from the 2013 grade of D-, but far from where experts like UC Davis professor Nicholas Pinter believes it should be.
Over 30,000 people living here, just a few tens of feet away from the Sacramento River. These people they depended this year on the existence of this structure, this levee, and it performing as it was designed to keep the river out of there.
And it's not just levees which are causing infrastructure experts to worry. The ASCII report also gave America's overall infrastructure a near failing grade of D+. Bridges got a C+. Aviation and roads were given Ds, and America's transit a D-, down from a D in the last report. How much money would it take to improve the country's infrastructure? An estimated $4.6 trillion by 2025, according to the report. At current spending levels, we'll be about $2 trillion short.
The former president couldn't get out of the Congress what he wanted on transportation or other infrastructure, water, and other projects.
In Sacramento, California, the need for improvement is especially critical. Rick Johnson is the executive director of the city's flood control agency.
Much of the levee and flood system that we live behind here was completed in the early 1900s. We have not invested in this and like a lot of our infrastructure in the country, and now we're finding that it needs upgrading to make it safe, to make it usable.
There are 106 miles of levees like the one I'm walking on here in the Sacramento area. 50 of those miles have already been refurbished, bringing them up to flood protection standards for the state. But experts and neighbors agree more work needs to be done, nearly $2.5 billion worth of it.
There's a cost to fix this levee over the next several years, but there's also potential cost of not fixing it. And that is a very real possibility. It's a calculatable percent chance that you're going to have a great big flood in the next 5 years, 10 years. And if you don't make that investment, the cost to those people, all these tens of thousands of people on this side, is very, very tangible.
Costs that experts say will continue to rise as more levees fall into disrepair. For Nightly Business Report, I'm Aditi Roy, Sacramento, California.
Two key House committees have approved the Republican-backed proposal to rework the Affordable Care Act. But even as it appears to be moving through the process swiftly, there are still a lot of questions and a lot of opposition. John Harwood is in Washington for us tonight. John, welcome. The House Ways and Means Committee voted after 18 hours of debate. The Energy Committee, 27 hours. Are things moving fast here?
They are moving fast. Those committees acted, of course, without a CBO score, which Democrats and some Republican senators have said they want to see. Remember, in 2009, 2010, it took over a year for the Affordable Care Act to move through with support from President Obama and a Democratic Congress. Republicans are talking about doing this, completing it in both chambers, getting it on President Trump's desk by Easter time. That's an extremely fast timetable.
You mentioned the markup there, John. Are there still questions about what this is going to cost?
Yes, for sure. Until the Joint Tax Committee scores the effect of the revenue provisions, until the Congressional Budget Office says how many people would lose or gain coverage and what the other implications for the budget are, we're not going to have a definitive sense of exactly what the effects of this bill are. Some things you can conclude in broad outline, but big questions. And of course, there will be further questions if Republicans have to amend this bill along the way to try to get more votes. It's a broad level of opposition right now.
And to that point, the opposition is coming not just from Democrats, but also from Republicans, most particularly, I suppose, in the Senate, where different rules apply. How big of an obstacle is this opposition?
Very big. You've got senators from states like Ohio, Rob Portman, West Virginia, Shelley Moore Capito, Arkansas, Tom Cotton, places where there are a lot of the blue-collar white voters who backed Donald Trump, put him in the White House. They are concerned about cuts in Medicaid. They're also concerned about how fast this process is going. So there are a lot of hurdles to get over. You also got conservatives who, from the other perspective, are complaining that this creates a new entitlement to replace the old Obamacare one. A lot of work to be done by the president and by Republican leaders.
John Harwood, thanks again. Appreciate it. John Harwood in Washington.
And still ahead, what Federal Reserve policymakers will likely be watching closely bright and early tomorrow morning.
Are you feeling richer? Well, new numbers today show that household wealth climbed to a record $93 trillion in the fourth quarter of last year. Year-end surge in the stock market and a rise in home prices added more than $2 trillion to household balance sheets. The Federal Reserve's quarterly report provides no information on the distribution of wealth among households.
The Treasury Secretary sent a letter to Congress warning them about the debt ceiling. Steve Mnuchin is urging lawmakers to raise it and that the country is set to reach its legal borrowing limit next Thursday. If Congress does not act in time, the Treasury Department will start taking extraordinary measures to prevent the country from defaulting on its obligations.
Tomorrow's monthly employment report is the last major piece of economic data to be released before the Federal Reserve policymakers meet next week. Following yesterday's strong private payroll number, tomorrow's report could seal the deal for just the third interest rate hike in the past decade. Hampton Pearson takes a look at what to expect.
When the Labor Department releases the February jobs report tomorrow, the consensus forecast calls for 197,000 new jobs, with the unemployment rate dipping slightly to 4.7%. But a blockbuster report earlier this week says private sector jobs surged by 298,000 last month.
But the bottom line is the economy is fundamentally strong. It was fundamentally strong before the election. It's fundamentally strong after the election.
Brand new data from the Labor Department shows a slight increase last week in first-time claims for unemployment benefits, up 20,000 to 243,000 the previous week. Not enough to slow the momentum, because overall claims are 6% lower than this time last year. And there's additional data from a global outplacement firm showing planned layoffs are down 19% from January. Wall Street economists expect another strong jobs report, building on the January surprise of 227,000 jobs. And if there are also signs of wage growth, the Fed will have a green light for another rate hike next week.
They've made tremendous headway on the dual mandate objectives in terms of getting the labor market towards maximum employment, and also they're just very close to hitting their inflation target for the first time in almost 5 years.
Tomorrow's jobs report covers the first full month of the Trump administration, with a solid job market serving as the foundation for growing the economy. For Nightly Business Report, I'm Hampton Pearson in Washington.
While the probability of an interest rate hike is increasing, the head of the European Central Bank is holding interest rates at zero. At a meeting today, ECB President Mario Draghi said the central bank plans to continue with its generous asset buying program until at least the end of the year.
The risks surrounding the euro area growth outlook have become less pronounced, but remain tilted to the downside and relate predominantly to global factors.
Mr. Draghi also said underlying inflation pressures remain subdued in the European Union.
Sears reports a steep loss, and that is where we begin tonight's market focus. The retailer posted its sixth straight quarterly loss and called the holiday season challenging as demand fell for appliances and clothing. But the results weren't as bad as analysts had expected thanks to cost cuts. Shares rose nearly 7% to $8.01. Meantime, JCPenney wants to get more customers into its stores by offering more services. Later this month, 100 stores will test new programs, including bathroom remodeling, smart home technology installations, and heating and cooling systems. CEO Marvin Ellison said it's what customers want.
I think it's a recognition that the customer's desires are part of our strategy. So specifically, we're trying to do a couple of things. We're trying to, A, find ways to grow. 2, try to find ways to de-emphasize our dependence on apparel, and also to find ways to serve our customers in a differentiated way.
Shares were up 6 cents to $6.30. When investors had their first chance to respond to Tailored Brands' wider than expected quarterly loss, and it wasn't pretty. The parent company of Men's Warehouse and Joseph A. Bank said weak traffic and a challenging environment caused sales to fall and miss estimates. Shares down 32% on the day to $15.84.
Staples swung to a loss and plans to close an additional 70 stores. The office supplies retailer saw revenue sink in North America, its top market, as customers move away from brick-and-mortar supply stores. Still, shares were off 5% to $8.49. Dutch paints maker Axco Nobel turned down a $22 billion unsolicited takeover bid from U.S. industrial company PPG Industries, saying that offer substantially undervalued the company. Following the rejection, Axco Nobel said that it would review the potential sell-off of its specialty chemicals business. Shares of PPG Industries fell more than 3.5% to $102.93. And the 3D printer maker Stratasys saw sales rise above expectations in the latest quarter, while profit also topped estimates. But the company issued guidance for the year that was well below street expectations, and that sent shares lower by 9% to $18.17. And Signet Jewelers is reviewing its workplace-related policies. The company is trying to stem the damage from sexual harassment allegations made against executives at one of its units, a story we told you about. Signet also reported better-than-expected quarterly profit, helped by strong demand for diamond jewelry. Shares rose 8% to $70.02.
All right, coming up, are those picture-perfect flipped-out homes really just masked money pits? Radio Shack files for bankruptcy again. This is its second filing in 2 years. The electronics retailer plans to close about 200 of its 1,500 remaining stores immediately. Radio Shack's CEO said Chapter 11 was the best path forward because it lets the company restructure while remaining in business. Radio Shack once had more than 5,000 stores in the U.S.
The ride-hailing company Lyft is expanding faster than it expected. The Uber rival has already reached its year-end goal of launching in 100 new cities. That's 9 months ahead of schedule. With the expansion, Lyft will compete with Uber in even more markets and continue to put pressure on prices, something Uber's CEO recently complained about in a leaked video. Uber is also currently dealing with accusations of gender bias and says it will stop using software to dodge regulators.
Lego today reported its highest revenue ever in its 85-year history. The Danish toy maker says demand for the ubiquitous colored plastic bricks and other pieces has grown globally. The company says it sees strong potential in China and is encouraged by results in Europe. Sales in the U.S., though, were flat. About 75 million Lego pieces, most of them in couch cushions, were sold last year in more than 140 countries.
Mortgage rates may be at a high for the year, but that's not stopping people from buying homes, fixing them with the intention of selling them quickly at a profit. In fact, a growing number of flippers are now seeing record returns. But buyers beware. The more flippers, the greater the possibility you could get stuck with a costly lemon. Diana Olick explains.
This historic D.C. row house looks like a renovated gem, outside and in. And that's exactly what empty nesters Cameron McGuire and his wife wanted.
And it was so seductive with all of the high-end appliances and those pieces, and we thought it was going to be a dream, and it really turns out to be a nightmare.
The 3-bedroom, 3-bath home had been renovated and expanded by a local house flipper with high-end appliances, fixtures, and finishings. It looked picture perfect.
Show me, because I am looking in this gorgeous kitchen and I'm saying it all looks good. What's wrong?
So when you look at it, things that you wouldn't even realize, receptacles are not permitted the way that they're installed here.
The list literally goes on and on. Improper light canisters, a fire hazard, a bathtub installed incorrectly. The emergency shutoff to the charming gas fireplace is behind the fire. And the new heating system had a 25-degree difference between the two floors.
It turns out there's not even a certificate of occupancy for this property. There is too large a space between.
They only found out because a D.C. inspector called investigating complaints from other homeowners who bought from the same flipper. And then came the killer code violation.
We purchased a 3-bedroom, 3-bath unit, and then found out that the bump out that holds 2 of the bedrooms and 2 of the bathrooms, this addition is illegal. And the city has the authority to make us tear it down.
The McGuires are now working with the city to bring the home up to code, but it'll likely cost more than $100,000, and that's on top of the $630,000 they originally paid. Unfortunately, stories like this are becoming more and more common as more flippers get into the business.
A lot of times we'll see where there's termite damage or water damage in a house and it literally just gets slapstick, right over top of it. So it's literally doing lipstick on a pig.
Stephen Carpenter Israel works only with buyers and helps them see what is behind the walls.
Flippers, the bad ones, won't pull permits. And at that point, you've got a huge issue because no one's looked at this.
He recommends flip buyers pull all the permits on the renovation, check that inspections were completed, ask for all disclosures on upgrades including receipts and warranties, have a professional termite and mold inspection, and make sure the property has a certificate of occupancy. And most of all, don't be fooled by fancy appliances and finishings.
All of those things were part of the appeal for us.
Because they just might be masking a mess. For Nightly Business Report, I'm Diana Olick in Washington.
And that's it for tonight. We want to remind you this is the time of year your public television station seeks your support.
Thank you for your support, and we'll see you tomorrow.
Nightly Business Report has been funded in part by...
All it takes is a spark. One idea to take flight. The courage to seek the unknown. To innovate, disrupt. To move us all forward. To explore a different perspective. At NASDAQ, we connect the world. Its ideas, its capital, its businesses, the people that drive global economies. The future isn't tomorrow, it's right now. All it takes is a spark. NASDAQ.